world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Welcome to Rebank. I'm your host, Will Beeson. Thanks very much for tuning in today. We're happy to be on iTunes, Stitcher, SoundCloud. Check us out, Rebank, Banking the Future. Subscribe, leave a review if you like the show, and definitely get in touch. We're on Twitter at Rebank Podcast, or you can connect with me, your host, directly at Will_Beeson, Beeson. We look forward to hearing from you. I've been looking forward to this episode for some time now because there's a lot of content produced around fintech and banking and some of the opportunities that the sector presents around digital transformation, enhanced customer experience, and new business models. But I find that a lot of the content stays relatively surface level. A lot of the trends and developments identified and discussed are relatively superficial. That's not to say they're not important, but it's very important to be aware of some of the deeper underlying trends that are affecting banking, finance, and monetary systems more profoundly, that are likely to have an impact not only on where incumbent thinking and business models go, but on where opportunities will exist going forward. I think it's important for anyone involved in fintech, be they an entrepreneur, an employee, an investor, a bank partner, to understand not only what's happening now and react at face value, but also to understand what the deep trends driving change, driving market developments are, how they're likely to develop going forward, and therefore how firms across the segment should be positioning themselves. I think Michael, based on his background and his thought process, has a deep understanding of some of these trends and is able to articulate them in an understandable way for a broad audience. So very happy to have Michael on the show today. He's happy to connect. The best way to do that is by email. He's at mpoconnor@mac.com, mpoconnor@mac.com. Hello and welcome to Rebank. I'm very happy to be joined today by Michael O'Connor, an independent fintech and banking advisor and investor with extensive experience analyzing, structuring, and investing in banking and financial services deals. Prior to going independent earlier this year, Michael was a portfolio manager looking at credit and banking deals for Arrowgrass Capital Partners, a prominent London-based financial services-focused alternative investment fund. Prior to Arrowgrass, Michael was a founding partner of Portman Capital Partners, where he advised UKFI and HM Treasury on alternative disposal strategies for UK government-owned banking assets. Michael has also worked in various senior roles at GLG Partners, Polygon Investment Partners, Deutsche Bank, and ABN Amro. Michael is a superbly sharp, thoughtful guy with keen insight into where banking and fintech are going and why. Michael, welcome to Rebank. Thanks for joining us today.
Thank you for having me.
I provided a brief outline of your background. Can you tell us a bit more about how you got into the advisory and investments work you currently do?
I think it largely sort of came out of my investment banking and then investment managing roles at various investment banks and hedge funds over the past 20 years. Specifically, in my last role at Arrowgrass, my previous boss at Deutsche Bank contacted me and asked me to set up a division that was going to look at opportunities coming out of the large investment banks due to the regulatory changes and the capital constraints that were going to be imposed as a result of the financial crisis. And this really led to two different sort of strategies that were interrelated. The first was looking at assets that were coming out of investment banks, which were no longer appropriate from a balance sheet point of view. So these would be capital relief transactions or risk recycling transactions, which were attractive for an investment fund that had a different balance sheet and a different regulatory environment. And then there were a related set of transactions which were driven by the same dynamic, which was largely new companies coming into the space often fintech companies that were looking to take advantage of banks moving out of particular areas due to their balance sheet constraints. And we looked at making both equity investments and partnership transactions, lending to those companies and buying assets from them to take advantage of that disintermediation of the established financial landscape.
Mm-hmm. One of the reasons I was so excited to get you on was because so often in kind of mainstream media you hear talk about fintech and what's going on in fintech and digital transformation and new customer engagement models in banking and financial services, which, while it's very much a real, tangible thing, is also arguably a symptom, a result of some very powerful trends that are affecting parts of the banking industry, kind of the core of large developed economies in ways that don't necessarily make the headlines. And I think you have not only extensive experience in looking at those trends and investing off the back of them, but I think you're particularly good at communicating some complex themes.
I think technology has always been massively intertwined with finance, and if we look at sort of the major changes that have taken place, certainly in my lifetime, things like ATMs becoming prevalent, phone banking, and then later internet banking. If you look at the way the clearing cycle, the ability of people to move money in and out of their current accounts, the ability to disintermediate your own bank through online deposits, for example, much of this has happened in the established financial sector. I think what's really happened post 2008 and what's really created investment opportunities and what's really created focus on this is the fact that while prior to that much of the financial innovation was happening inside the established players that were getting bigger and bigger, we started to see those big financial behemoths slowly get broken up, and as those tectonic plates have moved, that's created opportunities for smaller and more nimble players, and people have become increasingly focused on that. And it really is that ability to make very precise niche investments inside either finance or technology related to finance that people have got an opportunity to focus on.
So with your investor hat on, what most interests you about banking and financial services right now? What opportunities do you see?
I think there are a myriad of opportunities. And I think it is that sort of disintermediation. It is the fact that you're seeing some of the larger, more established incumbent players, particularly in banking, retrace, and that's going to continue because the balance sheet pressures that's on those players is going to be maintained and is going to keep on going forward. People talk about legacy systems, but it's as much the legacy books that the banks have that creates the opportunity. This is what really constrains them from a capital space. If you've already basically invested all of the levered money that you can, and you're having to reduce those assets because your regulation is saying that you need to hold more and more capital, your ability to generate new assets is very, very much constrained. And that's what really allows people with newer technologies that can outcompete, that can price differently, and that can assess risk more competently to move into that space. I think coupled with that, there's the other side of fintech as well, which is much more about providing technology services to all the players. And we're seeing that this comes in and out of vogue with various things such as blockchain and Bitcoin, which are sometimes seen as being complete devils within the system, and at other times are seen as being the savior of the financial system by allowing money to move around much more rapidly. So I think you have sort of true, genuine technology plays, which are interesting but aren't always driven by a financial model in terms of investment. And then on the other side, there are the opportunity to make much more financially driven investments with companies that are using technology as an enabler to just provide financial services more efficiently and in a better manner to their customer base.
Pre-2007, 2008, the model at incumbent institutions was very much originate assets, securitize, free up balance sheet, originate new assets, repeat. The securitization market fell off post 2008, but even 8 years on, it hasn't really come back. What's to prevent incumbents from reducing asset exposures via techniques like securitization in order to free up balance sheet space and start lending again?
I think in a large part it's regulation. And this takes sort of a myriad of different forms. The securitization market has recovered to a degree, and without any question, there are definitely securitizations that are going through, maybe not quite in the same scale and with the same breadth that they had previously. But I think that what has definitely changed is that the ability to move things off balance sheet at a ridiculously tight spread through securitizations is much, much lower. And in a low interest rate environment, that means that as a product placed, they're much less efficient. So I think for me, by far the most significant thing when you look at the securitization market is where the senior tranches trade and where they're priced. And when you compare those to, say, equivalent deposit products, for the level of risk that's being taken, it's not necessarily. It looks like a widespread, and what that's telling you is that the number of people who can buy those assets is limited. And I think a lot of this is due to the fundamental changes of the type of assets that banks themselves are allowed to hold. It's due to the increased regulation and the inability of, in particular, the investment banks to hold products that aren't for trading. That doesn't just impact the investment banks themselves, that creates a liquidity gap perceived by other longer-term investors, which reduces appetite there as well. And that's what's really constraining that marketplace.
So in terms of the fintech space, which is a very, very broad term, I appreciate, maybe we can break that down into a bit more detail. I know you've been involved in looking at some of the challenger banks that have come to market in the UK, initially as an investor at Arrowgrass and subsequently supporting with financing advisory. What is it that makes challenger banking an interesting space in the UK right now?
I think it's the broad themes that we've been talking about. It's really this ability to disintermediate the existing incumbents. And of all of the major developed economies, the UK is the one which has the greatest level of concentration amongst its incumbent banks, which have all got various different constraints. Obviously, Lloyds and RBS are in a category of their own because of their state ownership or partial state ownership. HSBC is a much stronger beast, but it's also involved in many other areas as well, which kind of constrains what they can do. And Barclays has problems and issues that are specific to them. And all of these banks are very successful, very big financial institutions, but because of their size, in a market where size is no longer seen to be necessarily the most advantageous place to be. And in particular, I think with things like leverage ratio coming through, the business models that have been in place are not necessarily as optimal as they were. It isn't simply about buying zero risk weighted assets and levering them very, very aggressively. But if you're very large, it becomes very, very difficult to pivot that business. And that creates opportunities. I think what's interesting for the challenger banks is they can find areas that are very large to a new startup, but relatively small to the incumbent banks, where they can offer genuinely new, exciting, and innovative products to the customer base and can compete on much, much more attractive terms than they've been able to do historically. And where the incumbent banks really don't have the opportunity to pivot and match that competition. And one of the reasons is that if you're attracting customers in a particular area, for a big bank that's got a huge book, they might be repricing a significant portion of that book if they try and outcompete you in the small area that you're attacking. And that really creates a great opportunity set. I think coupled with that, for the first time, we're seeing that the internet itself is able to really properly disintermediate the incumbents. So when I got my first bank account, pretty much all your financial products and services would go through a single bank account. So you'd have your savings in the same place that you'd have your current account, and loans would naturally go through the same provider, because there just wasn't the opportunity to look for alternative products. And where it was, there was very little price visibility and transparency. I think the real big change has been that with the rise of the internet, deposit accounts can be separated out from the rest of banking relationships. And that means that it's no longer necessary for a new challenger bank to set up current accounts in order to fund itself. And that's a massive change. That's the real game changer for me for the new challenger banks. The ability to genuinely disintermediate and cherry pick the product portfolio to offer what you think you have the most competitive advantage in, and still be able to price your liability side, the deposit side of your book, attractively compared to your peers is a completely new situation. Coupled with the regulatory changes and the fact that now it's possible to obtain a banking license without being fully capitalized right from the first conversation with the regulator, actually it makes it a very, very exciting and really interesting space to be in.
So we're, for the benefit of the audience, talking about the UK market specifically. We've seen two waves of challenger banks come to market in the UK, or I suppose more specifically, we've seen one wave of challenger banks come to market. We've seen a second wave prepping to come to market. And that first wave was characterized by effectively specialist lenders who were leveraging exactly that opportunity you were talking about, the decoupling of deposit accounts from the current account led model to fund niche lending, effectively perfecting maybe and improving on optimizing a traditional banking business model, so focused on net interest margin. The second wave of quote unquote challenger banks, maybe we can more aptly call them digital banks, are in large part looking to reinvent the banking model to a degree, often opening it up into a more of a platform, banking as a platform type model, bringing in third-party services, earning as much on a revenue share on a fee-based model as a net interest margin focused model. Looking forward, longer term, do you view one of the two models as more interesting than the other?
I think both models have a valid place. I think that the fee-based model is very interesting, particularly for new players when they are possibly capital constrained. And it's a way of offering additional services to their client base without necessarily requiring the capital and possibly the regulatory changes that will be required to do that. Having said that, I think that where those products are around offering specific financial services, so where this is around products that banks would traditionally offer themselves, ultimately, once you reach scale, it's better for the banks to move into those markets directly, because frankly, no one should be funding cheaper than somebody with a banking license. So you should be able to effectively make the additional spread yourself by offering those products. But clearly, where banks can offer products that are non-lending based through best of breed partners, so an insurance resale transaction, for example, I think that is much more likely to remain outside the challenger banks in the near term. It seems to me that this idea of financial wholesale institutions is a long way from what the challenger bank ideal is. But I do think that you will also see a continued growth in the specialist single area banks, because clearly this is an area this is an opportunity that is not going to go away, as the incumbents are restricted in particular spaces and can't compete properly, and where people can come in with technology enabled cheaper offerings that provide better services for clients. They should be able to make significant financial returns out of those products, and specialization, I think, will be something that will remain within the marketplace.
Do you see the challengers quickly being consolidated back into kind of a more traditional incumbent type system?
I think that's an interesting question, and I think we've already seen, with some of the internet banks in the States being purchased, and some of the investors who've come into some of the UK banks being established players, maybe the first possible signs of this. And of course, this is something which, particularly within the UK, we have a long history of. So I guess it was really, most aptly demonstrated by the fact that despite the skepticism of many city analysts in the 90s to the attractiveness of the building societies as they demutualized, almost all of them were gobbled up by the incumbent banks. I think the tide at the moment is very much against the Big Four buying additional banking assets in the UK, so I wouldn't see consolidation coming from any of the incumbents in the UK. However, I think it may well be that that newer, more nimble, higher growth, lower cost, attractive challenger banks are seen as a very good entry point for foreign banks to come into the UK market. Oddly enough, particularly post-Brexit, because of the lack of ability to passport banking licenses across Europe. Clearly, smaller, profitable, more nimble challenger banks provide a good breachhead for any European financial institution that wants exposure and access to the UK market.
You raised an interesting point there, and I guess it kind of links us back to some of the work that you're doing currently. That was around the composition of investor base for some of the challengers, and I guess for better or worse, the short and medium term strategies of challenger banks are often conditioned by investor requirements. If you're a challenger bank looking to bring a new idea to market and are raising capital from investors that have a need to monetize, to exit investments in the short term, you're likely looking at pressure to sell, to potentially to IPO at some point. For potential new banks coming to market, raising capital at the moment, what's your kind of high level advice, guidance in terms of how to raise capital, where to look? Does it make more sense to focus on technology type investors looking for that 0 to 1 growth trajectory, or are you better served by investors who are traditionally comfortable investing in financial services? Are there more or greater or lesser pressures, strategic pressures by approaching one group or the other?
I think there's probably a perception that, given the technological nature of many of these companies, that technology investors would seem to be the optimum, particularly early stage. But in my experience, and I think the realities are that financial assets are much better understood by financial investors, and challenger banks are much more banks than they are fintech investments. The technology is really an enabling part of the procedure. The characteristics are broadly similar to existing banks. They're regulated businesses. Ultimately, you take deposits and you use those to finance assets, and you have to hold a certain amount of capital against it, and your valuation is going to be based roughly upon how much value you create through that process versus how much it costs you to do it. And if you can generate a high return on equity, you'll be valued at a significant premium to book, and that allows your investors to make money. I think that compared to, say, a traditional technology business, the different investment profile that becomes more difficult to understand for non-financial investors is that for a growing bank, dilution is good. You want to be taking new money in because it's going to be valued at a premium to book, and that's what allows you to grow. The same isn't true for a true, genuine technology company, which, once it's raised the initial capital, can often grow without additional financial resources. So the investor base needs to be comfortable with this idea that there's going to be continued raisings and continued capital required as the bank is growing. And that requires an investor who understands that process. So for me, whilst there may be an early stage where You have technologically savvy high net worths or family offices or those style of investors coming in, and there's a great opportunity set there. I think at some point you flick round to being institutional, financial savvy investors who know what they need to do to enable the bank to grow, and how taking that additional capital is actually a good thing, and it's actually a sign that the bank is being successful.
You mentioned a couple of the recent regulatory changes, increased capital requirements here in the UK. We've seen some EU legislation, some of which has been replicated here in the UK. Initially, the Second Payment Services Directive in Europe, which a lot of people think is going to create new business models, as data sharing is effectively required between banks and authorized third parties. Similar legislation exists in the UK, and all signs suggest will be driven forward. There's a lot going on in terms of reimagining the banking model, and to an extent putting pressure on incumbent banks. Are there any risks or concerns that regulators at government should have about changing regulation that certainly encourages new entrants to market, but also potentially puts pressure on incumbents who are a very important part of developed economies and who are already under cost pressures and profitability pressures?
I think you raise a very interesting point, and I think everyone speaks about these institutions as if they're single entities. So everyone speaks about the government and regulation as if it's a unified single voice that's trying to achieve a single aim. And in reality, what's happened, particularly post the financial crisis, is that different branches and different parts of government are trying to achieve different things. And often it's mutually exclusive. So, for example, on the one hand, we want much safer, better capitalized banks that are de-risked for many reasons. We don't want to return to the problems that were created in 2008. And then on the other hand, we want our banks to be supporting the economy, and in particular lending to SMEs that are seen as being the engine of growth. And the fact that SME lending seems to go down is a reason to beat the banks and say they're not fulfilling the social function that they're required to do. And in reality, those two things are diametrically opposed. People think that because rates are low and because funding is available to banks, that they should have money to lend out to SMEs in particular and the corporate sector in general. The problem is there's a big difference between funding and capital, and the changes in capital regulations, in particular things like the leverage ratio coming through, massively restrict what banks can do in terms of additional lending. And whilst the willingness might be there, and whilst the business can be profitable from the point of view of where it can be funded, the problem is if you're capital constrained, it just simply stops you doing it from a regulatory point of view. So often you find that different parts and different agencies within governments have got different drivers in terms of what they're trying to do, and these regulations are crude elements to solve a particular problem, but they're not necessarily looking at the whole picture. And I think some of the other things that we're seeing coming in, so the data sharing, for example, the referrals that are required now for SMEs in the UK are another attempt to respond to this inability of the incumbents to on-lend. So they're trying to attract new entrants into the marketplace. Where I would have a concern with this is if that goes to non-regulated businesses. There are reasons why banks are very efficient at pricing this risk and why they are good at this particular business. And despite the wider sort of vilification in the general public, they're still much better behaved than many of the unregulated lenders that are out there. So my concern would be by pushing some of this business maybe away and out of the banking sector, it does create some additional risks in terms of the wider financing community.
So it sounds like you're referencing potentially some of the peer-to-peer lending platforms, which I suppose one of the concerns is the arguments is we can't necessarily rest assured that those models work or are in fact the panacea that some potentially view them as, simply because we haven't seen them, most of them at least, kind of operate through the credit cycle. Do you have concerns about the peer-to-peer lending industry?
I would have quite strong concerns about the peer-to-peer industry. I think it's conceptually a fantastic idea. I think it's very laudable in terms of what it's trying to achieve. But my concerns are based upon the fact that as it's become much bigger and much more institutionalized, the incentives for each of the different players are not necessarily aligned. So the peer-to-peer platforms themselves have generally been valued on revenue, not necessarily on asset quality, i.e. they don't have any skin in the game in terms of the loans that they're originating, which ironically is exactly the problem that people highlighted with CDOs, and it's why in that securitization market the originators were forced to retain a stake in the loans that they were originating, because if you have no incentive to screen the loans properly, then you know, push comes to shove, there's a risk that you don't, which was exactly what happened with subprime mortgages, for example, in the States. So I think having bigger and bigger peer-to-peer operators that are valued purely on volume and not necessarily on asset quality is a concern. My other concern with that is that as those books are growing, any problems with the asset quality gets masked by the growth itself, because you don't have enough historic data on the loan book as it exists to ever really work out what your true loss ratios are. And I think when we see these things go through a full credit cycle, I just hope that that we don't actually see that the assets themselves are much lower quality than is being purported for the investors.
Because I guess one of the headline concerns around, you know, any potential risk associated with peer-to-peer lending models is that you've got kind of mom and pop savers invested in these loans, which maybe once was the case. And while absolutely there are all sorts of negative implications of private savers, in some cases not necessarily financially informed, losing savings via risky platforms like this that may not perform in negative credit conditions. To an increasing extent, we have seen in the past few years at this point, institutional involvement, i.e. levered involvement in these platforms, with the, I suppose, the contagion risks not being dissimilar to what we saw in 2007-8 during the subprime crisis.
I actually think, personally, getting the institutional money into peer-to-peer platforms is a good thing, because the discipline that these investors are putting into their investment process and the skill set that they have is maybe of an order of magnitude greater than the sort of mom and pop investors. So I think that actually they are doing maybe some of the base credit work and screening that might otherwise be missing to ensure that the assets are of a higher quality. And the amount of leverage that's put in by them is generally pretty constrained by what can be achieved, either if they're a hedge fund at their prime brokerages, or if they're specialist funds, it'll be restricted by mandate. So I think that there are some benefits, particularly in terms of the asset quality screening side, which are good. My concern about the involvement of institutional money in peer-to-peer is actually the conflicts of interest that come with it, because 9 times out of 10 you're also still having the sort of mom and pop investors coming along, and they may not be getting the same loans that the institutional investor is. So how are the peer-to-peer operators deciding who gets which loans. And the natural concern would be that if you're operating it on an economic model and you're the peer-to-peer operator, you would give the better quality loans to the bigger investor, who would be the institution, and maybe the mom and pop gets left with lower quality, either lower yielding or possibly more risky investments that's left behind.
In terms of culture in the banking industry, we saw the Wells Fargo scandal break not long ago. 5,300 employees fired over the past handful of years for, quite frankly, defrauding customers, which isn't merely shocking in my opinion. It's outright enraging. You've worked in financial services for a long time. Is there a cultural issue with banking with incumbent institutions?
From the experience I've had, I've worked largely in institutional markets, making institutional investments, both buy and sell side. And whilst there's definitely been cultural shift and change from the more old school broking style of the early 90s through to what we have now.
He's saying that with a smile on his face.
It was much more fun in the early days, that's for certain. But I would say the vast majority of people that I've worked with, the overwhelming majority, have an exceptionally high level of integrity and are incredibly honourable. And that maybe is a little old school. And it certainly used to be the motto of the stock exchange, and it used to be that integrity was almost taken for granted. And I think that is still prevalent. However, when you're talking about potentially large sums of money, you will always find a few people who maybe don't behave up to the required standard, and I think that's true in any industry. I think that there has been a massive tendency in the press to create this mythical banker who's a unified persona who works everywhere, when the reality is, if you go to any of these large universal banks, there are hundreds of thousands of people working, doing everything from accounts, basic telling, through to making very important investment decisions. And the roles are very, very diverse, as are the personalities, and as is the sort of behavioural patterns. But by and large, I think people have behaved pretty. I think that there are a number of very deeply shocking scandals, but most of the people I've worked with have been pretty decent and pretty honourable. There's definitely been a cultural change, though. I think it's as much societal as well as banking, but I think the sort of focus on very, very heavy, aggressive sales targets and bonus culture seems to be less prevalent than it used to be, shall we say.
But I guess there's still the issue of the modern company is theoretically operated for the sole benefit of its shareholders, and suddenly making any sort of potentially objectionable decision, as long as it has a positive ROI, is justified because it's in the shareholders' best interest. From a societal perspective, both now and over the longer term, if we continue to see the same level of competition amongst institutional investors, insistence on returns, do you think that structurally risks arise for society? First question, are investors wholly focused on financial returns? Second question, should they be?
I think I'd love to be able to say no, they're not, but I think for the vast majority of investors, they're paid by the people who've given them their money to make as much of the money as they possibly can. There are a few ethical funds, but not very many, and they're not significant enough to make a difference. So the mandate that's given to the investors is such that actually, yes, the vast majority of them will be focused on investment returns. But I would keep on highlighting this is not a banking issue. And if you look at, for example, the emission standards tests at Volkswagen, which to me were just as shocking and just as prevalent in the automotive industry. It's not just Volkswagen. From we can go back to Bridgestone and the tire scandal. These things happen in multiple industries. Oil and gas has had many, and frankly, disastrous consequences from the mistakes that they've made. Much of which has been due to misconduct. If we look in the pharmaceutical industry and some of the consequences of mishandling trials, which have led to fatalities. Again, you look at the scandals of drug selling in China from some of the world's very largest corporations. But this seems to be almost much more accepted as just being a part of business in sectors outside of finance. So I think this sort of cultural change that's needed that you're really referring to probably is wider in nature, but I think it's quite hard for it to come through from investors. The big caveat I would say is I think in banking and finance, that's where investors will have a greater say about it, because misconduct costs them money. Much more than it has in maybe other sectors. So and because of that, I think that you will see that good governance will become increasingly the norm in particular in banking.
So taking a step back and looking at banking, financial services, fintech more broadly, are there any specific companies or niches within that kind of large area that you see as particularly interesting investment opportunities at the moment?
I won't name specific companies, but I think anything that's disruptive and anything where the new player has a very precise and definitive advantage over the incumbents, or where they create a new market that didn't previously exist, that's always attractive. And I think if you couple that with areas that are easily defensible, i.e. it's difficult for competition to move into, they're the sort of key characteristics for me, if you like. So I must have seen 100 different blockchain companies, all of which are technologically very good, and I'm sure at least, I'm sure several of them will make an absolute fortune. The problem is, I'm pretty certain that the vast majority will not be heard of again. And picking the winners is not necessarily driven by the technology. It's much more driven by their business contacts and how they can use and lever that to get high adoption rates. It's more of a sort of VHS Betamax issue rather than something that you can look at and just derive from the technology side of things.
I love that analogy. Michael, thank you so much for joining us today. It's been an absolute pleasure to chat. What's the best way for people to connect with you, find out more about what you're working on?
Probably email's the best mechanism. My personal email is mpo'connor, all one word, no apostrophe, @me.com.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.